Hello, everyone. I'm Daniel Gorfine. Thrilled to be back at the conference here in Jalapa. Every year, you kind of outdo yourself, so thanks for having us back. So I'm going to moderate a panel here that maybe not the spiciest, but definitely has the most ambitious name. So let me read what we're about to talk about. Blockchain, Web 3.0, digital identity, and the future of finance, just to boot. So to help us do that and kind of unpack this topic, I have a set of excellent panelists. I'll ask each of you to just briefly introduce yourselves and just say as well briefly how your day-to-day work touches on any one of these topics that we'll be covering. Austin, I'll start with you.
Oh boy. All right. So I'm Austin Campbell. I'm an adjunct at Columbia Business School, and I've been kicking around and call it the market structure space from the traditional finance perspective. I was at JP Morgan for a long time running a lot of cash stability products, thought a lot about settlement risk, counterparty credit, price stability, all the boring stuff that actually matters. And then I was at a couple of crypto places, most recently ran the stablecoin platform at Paxos. So I helped build PYUSD, among other things.
Excellent. Okay, Rachel, please.
Sure, and I'm a late addition to this panel, so thank you so much for having me. And also a late addition to this conference, which is absolutely phenomenal in terms of lineup. But Rachel Andrica, I'm the Chief Operating Officer of Anchorage Digital Bank. And so for those of you who don't know, Anchorage Digital is a regulated institutional custody platform. And back in 2021, we received the first federal charter through the OCC, and we are a national trust bank, so hence the name Anchorage Digital Bank. I came to this space. I started my humble beginnings as a lowly OCC bank examiner, and later went into the consulting space for about 10 years, where I worked not only on regulatory remediation, but also bank licensing strategy, and that's how I met Anchorage Digital, kind of working through the licensing considerations when under the Brian Brooks's administration.
Excellent.
So, thank you.
John Stark. Good afternoon, everyone. Thanks for sticking around. I worked at the SEC in the Division of Enforcement for almost 20 years, 11 of which as the chief of the Office of Internet Enforcement. After that, I ran the DC office of a global data breach response firm. And then I started my own firm. So I'm just here representing myself. I have no stake in crypto of any kind. I've probably written about 150 articles about it. I also taught at Georgetown for 15 years as an adjunct. And now I teach at Duke it's a similar senior fellow or something. It's an adjunct. An adjunct is Latin for not a real. And so sorry.
Can confirm.
Yeah. So, but like I said, I have no stake in crypto. If it goes down, I am the same person if it goes up. I'm completely objective. And, but I do speak my mind because at this stage in my life, I think we're at a crisis. So turning to the next speaker.
You'll notice in my bio, I'm an adjunct at Georgetown Law. Anyway, please, Kevin.
I'm Kevin Werbach. I'm a real professor. Which also means I can speak my mind because I have tenure. I'm the chair of the Legal Studies and Business Ethics Department down the street at the Wharton School and the director of the Wharton Blockchain and Digital Asset Project. I've been working on legal, regulatory, business, and policy issues for emerging technologies for a very long time, and I always look to try to find interesting, significant technologies that have the potential to be broadly transformative early on, when there's still a great deal of uncertainty about them. And so for now close to the last decade, blockchain and digital assets has been one of the spaces that I've concentrated on, and so that's my connection.
Awesome. And Kaitlin, please.
Hello, everyone. So last year, Jalapa knows I was supposed to be here in person at the last minute. I could not travel and had to be a big floating head on the screen. So I'm really glad to just be one of the panelists this year. So my name is Kaitlin Asrow. I'm the Executive Deputy Superintendent of Research and Innovation, no adjunct in that title, just straight acronyms. And in that capacity, I lead a number of different functions for New York State, the financial regulator in particular. So I lead all economic reporting and research for the department. I also do innovation policy. So all of the kind of buzzwords up here, I'm responsible for thinking about. I have a team of analysts who present to the superintendent and myself what we might do about these issues. I'm also responsible for virtual currency oversight for New York State. So that includes the bit license regime, for those of you who are familiar. And I also am in charge of all limited purpose trusts. So these are the trusts in which we have allowed to do virtual currency activities under our banking law in New York State. And finally, I didn't have enough to do, so I started a data governance and management initiative where I'm just playing with the data that we have in New York State. So a lot of intersection with these topics.
Excellent. Okay, so let's start with definitions. And the first definition will be for Web3. What is Web3? Is this like a future state? Is it the Ready Player One book or movie? Or is this just synonymous with, crypto speculation? Like, is this a real thing? So I'm going to go down the line because I think this will set the tone of our conversation. No pressure, Austin, please.
Yeah, well, as stated, I'm probably the boring one. So I kind of think of Web3, and one of the earlier talks referenced this as just an open access, opt-in global omni-ledger for people to exchange value, right? Like right now, quite frankly, we do that with blockchains, but if somebody were to propose an equally valid technology that didn't use it, great.
Okay. And so you view Web3, though, in the financial services context. It's value trade.
Not just financial services, but I would call it more the open access to value in general.
Okay. Rachel, since you've had 5 minutes to think about this question.
Or that I think about it every day with everybody else on the panel. And I echo what Austin says, absolutely. But I would also kind of put out there that, the interaction with the digital space and the way that we do that, the infrastructure from which we do that has evolved quite a bit, right? Over the past, since 2013 through to 2017, and now into 2023. And when I think about Web3 and I think about like the evolution of like what you can do on a blockchain, that has significantly changed since the Bitcoin white paper, right? And so, we talk about like, we had Stellar, come up here. And one of the things that I really love to do at Anchorage Digital is to take a look at all of the assets that we list. And I get to see all of the cool things that are happening from all of the different protocols. And that has really greatly evolved. And just because it has moved on from, peer-to-peer payments to our ability to crowdsource, to now, the evolution with regard to NFTs. I mean, these are things where we are changing the way that we interact with the digital space. And when we talk about like Web3, that's kind of a loosey-goosey concept. And I think that it should remain a little bit loosey-goosey because it really is, I think, more of a concept in how we use this kind of like distributed ledger technology.
Okay, John, do you agree with this? Is it kind of anchored in this notion of ledgers? Is that what Web3 is about?
I guess for me, it's sort of like a cross between the kid in The Emperor Has No Clothes and Tom Hanks in the movie Big. Remember when he gets his hands and says, I don't get it. I don't get it. Okay, I think Web3 is a bunch of marketing theater. And I think that the tech here is all marketing theater. Stephen Deal, who was on the panel this morning, was very modest, a superstar technologist, and he wrote this letter. It's called the Concern.Tech letter, and you can see what he and more than 1,500 other technologists talked about in how blockchain was really just a glorified append-only limited writer spreadsheet. I had a friend from very big technology talked to me once, and I've been writing about this since 2017 and working within the juxtaposition of technology and law and business for 35 years. And when I was in charge of the internet, the Office of Internet Enforcement, I was an internet evangelist. I was traveling the country. I set up the first computer terminal in the Division of Enforcement to actually view the internet. I set up the first email box in the enforcement division at the SEC. It was enforcement@sec.gov, and I got to work every morning, and I read every email that came in reporting suspicious activity. And I would go around and train litigators how to use the internet for their litigation. And I look at things like the cloud, and I look at things like AI, and I get very excited. But I look at blockchain just not the same way again. And my friend from this big technology firm said, John, it's a spreadsheet. And I said, you're right. And I think that this idea of decentralized finance is nothing new. You know, when I was chief, again, it was called disintermediation. And if you recall, if you're my age, and I realize I'm a boomer, or even worse, maybe older than that, so you can certainly say, okay, boomer, whenever you want, but that doesn't make me wrong. I think that it just makes me old and a little grumpy. But I think, so there was this guy who set up this thing called Spring Street Brewery. How many remember that, or can remember Spring Street Brewery? Okay. He did an offering over the internet. It actually was an exempt offering. And it was amazing. He raised a couple $1 million, and it was front page of Wall Street Journal, front page news everywhere that the internet was going to take away the disintermediate, all these great things were going to happen. And then he set up an online place where Spring Street Brewery shares could be traded between people, and they could meet, they could talk about, all the things that were going on. And what it was like a driver's ed film. You know, at the time I was teaching at Georgetown, it was a driver's ed film of securities law violations because, of course, he was operating as an unregistered exchange, as an unregistered broker-dealer, as an unregistered investment advisor, as an unregistered clearing firm. And all these violations were happening at once. So everybody was coming to my door from every division at the SEC saying, you got to charge this guy for Spring Street. What are you going to do? So we set up a big conference call, and there were like 30 of us and just one of him. And this is all public. This all became public because one of the commissioners actually reached out to him and said, did the SEC staff treat you well? I mean, his heart was in the right place, but he was a Cravath Harvard lawyer, and he knew exactly that he was violating every single rule. Why was he violating? Because consumer protection is critical. This idea of smart contracts in the middle of transactions smart contracts are neither. There's no chance for remedy. There's all sorts of cybersecurity problems. You know, they were talking this morning about making blockchain, transparent and using Uber as an example. Well, that's great. Let's tell the world that my daughter is alone at 12 midnight waiting for an Uber car to pick her up. You know, so these are very, very important things that are going on that I think are glaring violations. And when you look at things like decentralized finance, you can see that it's really just deja vu all over again. And what bothers me the most is it's become this affinity fraud because, and there was some talk this morning on a panel that Hillary Allen and Stephen Deal were coming from a place of white privilege because they were stopping the unbanked and blocking financial inclusion. Well, there is not a shred of evidence that these technologies bring about financial inclusion, but there is plenty of evidence that they do the opposite. Because if you look at what the Brookings Institution did, a study from Carmona to Nansen, and I'm surprised the Brookings scholar didn't bring that up in the panel, that people of color are the ones that are hurt the most by crypto. A study from JP Morgan, Michelle Singletary, who writes for the Washington Post, wrote a story about how this was hurting people of color. Michelle's been around for like 30 years. So it's an affinity fraud, and it turns these victims into victimizers. And it's cult-like, because just follow me on Twitter and watch anytime I say anything remotely anti-crypto, and you'll see some of the most vitriolic hatred ever. You know, everything from anti-Semitic screams at me, threats to my family, all kinds of things for just stating what I think is the obvious. So that's what I think of when I think of Web3.
So you don't like it? Okay. So let me try and bring this back to the original question. Microphone is off. How about that? Better? Okay. I'm a real professor, so I can project my voice, so I don't necessarily know. But no, in all candor, our adjunct faculty are wonderful additions and contributors to the institution. The question is about Web3, and I was going to make the snarky comment for this panel that Web3 is the adjunct internet, but I won't do that. When people use the term Web3, they're really meaning one of three different things. One, John alluded to, is a marketing rebrand of crypto. That you basically delete the word crypto or whatever variant of it. Well, that sounds too speculative, and Web3 is the term that gets used. That's not terribly helpful. To the extent that's what people are doing, it's not really shedding any light. The second meaning of Web3 is a little bit more productive. It's what the term seems to suggest. It's an idea of a third era, a third iteration of the internet, Where the original internet was open and largely decentralized, the second age of the internet has been typified by large centralized digital platforms which exert tremendous control over data and people's lives. And so the vision, which I think is a very wonderful aspirational vision of Web3, is maybe we can move using blockchain technology or really potentially other things to a more decentralized internet where we go back to that openness but still have the potential of the extraordinary scale and capacity of today's technology. That, I think, is a very heartwarming vision, but it's pretty general. The third one's a little bit more specific. Web3 is a particular business model. It's a particular structure for how companies develop and grow based on tokenomics, based on the idea that digital assets, that tokens, are the mechanism of aligning incentives among stakeholders, the mechanism for capital formation, and also the mechanism for coordinating governance. And the argument is this is the way that these new platforms will be able to overcome the network effects of the incumbents. The challenge with that model is from a distance, it's almost impossible to distinguish something that is actually using that token-based model as a way of facilitating new kinds of innovation that's more open and undermining the dominance of digital platforms from what John described, which is basically a collection of pump-and-dump Ponzi schemes. And the challenge of Web3 is that because these services that we see out there inherently rest on this token-based model, it's impossible to completely divorce the potential that it's just speculative or people are using this as an opportunity to enrich themselves. I see a lot out there that's not that, but it's impossible to completely put it to the side and say none of it is that.
Kaitlin, please. What's Web3?
Yeah. I think, I'll focus probably on the middle description that Kevin laid out, which I think for me takes us a little bit outside of kind of speculation and the pure crypto space, which I personally, just from kind of an intellectual exercise, enjoy a little bit more to think about that, vision of Web3 as really, I think what David framed earlier, I'm not going to call it decentralized, but more like self-serve. Self-serve internet again, and then I really like the idea that is in Web3 of kind of user rights, data that's really accessible and controlled directly by me as the individual. And I think there's opportunity there, but it just feels like there's a lot of grab bag of technology. Artificial intelligence, machine learning is central to it, Internet of Things, blockchain, and all of these I feel like have a lot of that buzz, and I'm not sure quite where they are in their readiness to launch this very grand vision of Web3. So a great hypothetical intellectual exercise, and maybe we'll get there, but we have a lot of Rubik's Cube's parts to work through.
So let me ask this next question. Why do we need this? So I've heard decentralization, and I heard that, we're at Web 2.0, we have gatekeepers, we have intermediaries. So what's the opportunity with Web3? And then what are the component parts? And I'm sorry, I am a lawyer, so there's always like multiple subparts to my questions. But why do we need it? And what are the necessary elements? What are the necessary components of that? Maybe it's your second definition, Kevin, of that Web3. I'll run down the line again because this is working well. Yeah, please.
So I'll start by saying with my answer, one of the interesting things about it is that I think the people in this room, and quite frankly, the people in the U.S. economy probably derive the least value from this as currently described. But I want to go back to what I was saying previously, which is when you have a global open access omni ledger where, quite frankly, I kind of agree with some of the things that Stephen was saying earlier, where the technology is not that transformative. But to talk about another Steve that I think technology people have a interesting relationship with, it's kind of the Steve Jobs thing of sometimes removing features is what makes the product, right? Having an immutable ledger where I can transact without counterparty credit risk, open source at all times is eventually going to eat everything. Now, that's not a statement about crypto. I infuriate everybody with my views and that I think blockchain's going to eat the world, but Bitcoin's probably going to zero, which now everybody's angry with me. But I think thinking through the future structure, which is very hard for us in the current moment with the bundling of financial services that Brian Brooks was referring to, and the current technology stack really misses what happens is a open access opt-in system that everybody can build on with much deeper liquidity is extremely valuable to global economics. And where financial inclusion matters, there is not specifically including people in a lot of the scams that are out there right now. I agree with John that that's a strict negative, right? I think what matters is many people with systems far less legitimate than the one we live in every day have the ability to opt into this instead.
So you know, the blockchains then are plumbing their infrastructure, which people talk about. And that does matter when a lot of like legacy institutions use very traditional kind of siloed Scotch tape and bubble gum together databases, and that's really inhibiting to your ability to interoperate with others, to automate activities. So, you know, as you can tell, I tend to agree with you. Am I allowed to do that as a moderator? Rachel, please.
So +1 to everything that you've said, but I think that, you know, more importantly, I don't think that anybody in this room or on this panel is being asked to make a decision as to whether or not we need it, right? This exists, right? And it exists not only in the US jurisdiction, but also globally. And not only are institutions interacting with it, but also consumers. And everybody deserves some amount of protection around that. And so at Anchorage, one of the things that we do is we provide institutional custody. Now, what does that really mean in this space? You know, custody is inherently a security activity in the crypto space, right? I mean, our firm was founded by 2 security engineers, and what we do is we keep safe the private keys, right? And that exists for sophisticated investors in this space. It exists for venture capital firms and hedge funds and institutional traders. Secure segregated custody does not really exist in the retail space, right? So consumers who are right now interacting with that don't really have that type of segregated protection with their own capital, with its own capital base, the way that like a bank would have, right? Like the way that we do. And so I guess I would say that nobody here is being asked to make a decision on that. Nobody's saying like, hey, like, hey, Dan, do we need this? It's being used, right? And so what is our job here? You know, our job here is to make sure that it is, you know, brought within the regulatory perimeter. And as such, we are able to then, afford the same types of protections that we would expect in a fair and orderly marketplace. We would then be able to export requirements under the Bank Secrecy Act, all of those things that we, you know and love about a safe and secure financial space.
John, go ahead. Looks like you have something to say.
Well, you can ask me. I mean, nobody asks if we need to have human sex trafficking or blood diamond mining or ransomware. But that doesn't mean we can't answer the question right here and now, because crypto is a killer application. It has an incredible use and one that we really haven't touched upon yet. It's great for criminals. I'm an expert on ransomware. Just about every single government agency, every single government agency has come out and talked about the criminal uses of crypto. So let's just go over very quickly some of them. Ransomware. But for Bitcoin, ransomware would not exist. Now, I'm a ransomware expert. Okay, I've been doing cyber my entire career. I've worked on dozens and dozens, maybe hundreds of ransomware cases. In 2022, there were SARS reported of ransomware. I think there were 1,251 incidents, ransomware incidents reported to FinCEN on ransomware. 1,251 incidents, I think 1.2 billion in payments. You know how much money was recovered from that? 0. You know how many of those people got caught? None. Occasionally DOJ catches someone, but it usually takes like 5 years to do that. I wrote a big article about this called Crypto Traceability, the Big Myth. Ransomware.
Can I abstract you from this though for a second? Can I ask, beyond cryptocurrencies, what about broader tokenization?
Sure. Okay.
Do you have a more bullish view? Because again, thinking more, well, I don't know if you can have a less bullish view. But
okay. Shocker, I have a less bullish view. Okay, this is what I think. So, but just to finish ransomware, I help run a ransomware conference every year with 40 or 50 of the greatest ransomware experts on the planet every year. And there isn't a single one of them that wouldn't say, but for Bitcoin, there would be no ransomware. Or there isn't a single one of them that wouldn't say North Korea uses crypto to commit for their nuclear weapons program. But to get to your question, because I think it's all wrapped together, right? We can't, if you want to divorce blockchain technology from all the tokenization and the investing, that's fine. You know, Goldman Sachs wants to build it in their back office. Have at it. You want to build your NFT so that you can look at it? Have at it. But that's not why people buy these things. They buy them because they think the price is going to go up. So to get to your question about disintermediation, the intermediation, the banks, credit cards, PayPal, Venmo, Zelle, these are critical for the consumer. Think about the Celsius, BlockFi, FTX, or any other entity. When you wake up in the morning and you get a message that says all your retirement money is gone. Like imagine if I got that. You know, I'm about in retirement. Or you know, I'm paying for my kids' education. It's all gone, and you don't have access to it. And like, you know, look at Coinbase and Binance. Anything bad happens as those entities, FINRA doesn't go in there to do an examination. The SEC doesn't go in there, can't rush in there to do an examination, like if it happened with the bank. With banks, there are literally Federal Reserve compliance examiners that live at the banks. So why would consumers want to get rid of this critical intermediary for if there's a problem? If there's a problem with your credit card, what do? You cancel the transaction. Somebody steals from you, what do? You call the intermediary. So getting rid of this intermediary and replacing it with code, you know, Hester Peirce is a friend of mine, a brilliant lawyer. Her heart's completely in the right place. And I listened to her speak. She's a commissioner at the SEC, who they call the crypto mom. And she said, you know, these smart contracts are very interesting. And I don't think so. You know, okay, you want to use an automated payment for some emergency situation, but we have all this AML. We have in the United States 12 different or 13 different statutes that are about money laundering. You don't have a right to financial privacy in this country. I'm sorry. I'm a libertarian. I wish I would sign and approve of anything that any anti-AML law, because I think that terrorism is a bad thing. But the reality is, when I was with the SEC or criminal prosecutors, they can get a look at every single transaction that you've ever done. And your bank teller might write a suspicious activity report just because you looked at them the wrong way when you were depositing your $10,000 or withdrawing your $9,999. So you don't have that right to privacy. And I get it. You don't like that. I don't either. But the alternative is to let terrorists do what they do. So in answer to your question, I think we need the intermediaries. We need them for AML. We need them for your trust. And they're vital for the consumer.
Rachel, did you want a quick response?
Yeah, and I actually agree with what you said about the intermediaries. And I think, you know, we're a bank. So I love intermediation. I love regulation. I love the Bank Secrecy Act. We're loving that. But you know, one of the things that has been mentioned here around speculation, and so you know, we're a trust, right? So we keep safe the private keys. We serve institutionals, and those institutional investors are speculating, right? Venture capital funds, hedge funds, family offices, you know, they have trading strategies and they bring capital into the space. They invest in token projects, right? And I think that that's not like, I mean, I know that we talk about this and we talk about the consumer protection around it, but, you know, there's a lot of reasons why speculation can be a good thing. It's the attraction of capital into a space, right? And that it can promote the building of greater infrastructure and, you know, greater regulation. And I think—
What if it's based on the greater fool theory? I mean, how do you value crypto anyway? There's no cash flow, no balance sheet, no nothing.
Well,
it's just greater fool theory.
I'll hop in there and say the greater fool theory really depends on like the clash of ideas in a marketplace. Like as somebody who's run a market making desk at an investment bank, I definitely disagreed with a lot of the reasons that people were making trades. But I will say that without speculation, you're going to have much more jagged, much more illiquid, much more inefficient markets than if you allow it. And the real question, which, John, to your original point, I want to say I completely agree with this, is eliminating the scammers, the frauds, and the criminals. If people want to do dumb things fully informed, more power to them.
Yep.
Right. Well, eliminating would go too far, right? I mean, traditional fiat currency is used for all sorts of terrible things, but also used for all sorts of good things. And this is true of any financial platform and any technology. And so I think we tend to go too far down in terms of saying, either we have the bad stuff or we have to give up something else. The question, to get back to the original question that's posed here, what do we need if Web3, whatever that means to us, is going to develop and be beneficial? We need to get to a place where there's a confidence level that the benefits exceed the downsides. And that includes being honest about both of those things and looking at what it takes to magnify the benefits and to mitigate the downsides. And there's actually a lot of work going on in those areas in the industry and increasing engagement with regulators, but still a long way to go. The one answer I would give to the original question is what is necessary is very simple. It's trust. Trust is what makes people willing to take risks. It's what facilitates activity. And the problem with traditional systems that are intermediated is that they require some centralization of trust. And that's beneficial, it's efficient, it's necessary, but the person you trust or the entity you trust might be untrustworthy. Or maybe they're very trustworthy, but someone steals their key and then undermines the security of the whole system. Or maybe there's inefficiencies because you have one trust relationship and there's another trust relationship that's separate. This is what happens when we have to do cross-border payments. So therefore you have these silos, and the fact that the trust is centralized in each one causes inherent inefficiencies. The idea of a decentralized platform, the kind of open, interoperable platform that blockchain represents, is a new kind of trust. It's the promise of a kind of trust that doesn't have those limitations. It has other limitations, and there are other questions about whether it will realize its potential. But that's really what's underlying all of this, and really what we need to get to. I'll say one more thing, because I don't want to keep Kaitlin from speaking, but the one other component that hasn't been mentioned that's going to be essential is decentralized digital identity. Identity is the foundation both for the value of these services, but also for addressing a lot of these harms and malicious uses we're talking about. And the trouble with the traditional identity systems and things like the traditional AML system is that, again, it's too centralized. And it's problematic, it doesn't always work, potentially leads to surveillance and so forth. Now, again, not saying that means we shouldn't have AML regulations, but it's in the interest of governments as well to have implementation of systems that provide all the benefits of digital identity without the downsides of centralization. Again, a lot happening in that area, but still very early.
And we'll come back to digital ID, but Kaitlin, you hear this, and you're a regulator. So what's the role of the regulator here?
I mean, I think, well, first I have to make a plug for just, generally, obviously everything that John is saying is quite resonant in many ways. But I will say, I am responsible for directly regulating some virtual currency companies. So I am going in and doing full scope exams and digging in. Obviously, it's in the jurisdiction of New York, but again, me speaking for myself from an intellectual perspective is quite interesting. I've been studying innovation for a long time, and now being able to go in directly to these companies and regulate them is quite fascinating. But, I think Web3, I would say as a regulator first, we keep vacillating on this panel of which version of Web3 we're talking about. So I think the first thing we need as a regulatory community is say, what are we even talking about here? What is actually just the technology versus what is arbitrage or business systems that are layered on top of it? What is speculation? We're just talking about crypto versus what is actually kind of this futurist vision of, digital identity and user data control. So I think just parsing through those things are necessary. And, I want a lot more information on the readiness of the technology itself to actually underpin some of these concepts.
Okay, so let's come back to digital ID, because that is critical. And if we take a kind of an idealistic view of the future, that has to be solved. But when we say that, I don't know about some of you, but when I hear digital ID, I'm like, well, I have my driver's license. I can take a picture of that and upload it. Is that my digital ID? Apple can read my face on my phone. Is that my ID? So what are we talking about? What's a digital ID? Who's doing it? Who's likely to create the digital ID solution that works for this future, definition number 2 of Kevin's Web3 that we all can get behind, I think. Maybe John, I don't know. So who wants to help me with digital ID?
Well, I'll start and say fundamentally, if you strip away all of the technological discussion and just ask what is ID, it's that you know who you're dealing with and can trust that, right? To go back to the concept of trust that was raised previously. The reality is part of why our AML system has problems, part of why global transactions has problems is that we're pretty poor at coordinating that internationally right now. So the reality of solutions is that they are going to be emergent and fractured and come up in pieces and bits. And I would say the fact that the system on that is very early and kind of broken is not bad. The long-term solution for that will be whichever regime wins that brings that trust that you know who you're transacting with certainty, and that's actually who the interaction is with.
And I mean, I open it up to anyone who wants to jump in on this topic, but Kevin, you raised it. Who's doing interesting work in decentralized digital ID? Where is this going to come from?
So there's a lot of work that's going on. There's work on what's called self-sovereign identity. There's actually a World Wide Web Consortium standard for decentralized identifiers. It's a matter of breaking down what we're using identity for. So you talk about the driver's license. So I go into a bar. I got gray hair. I don't have this problem, but I want to prove to them I'm 21. So I hand them my driver's license. They now know what color my eyes are. They know my home address. They know a whole bunch of stuff. And they know it says my age on there, but that doesn't even really prove that I actually am who I say I am. So there's a security piece of it. But fundamentally, there's an attestation piece of it. What I want is some proof that some responsible entity, whatever the government agency is that's relevant, that can attest to the fact that I have a valid birth certificate, that in a cryptographically secure, private way is provided to that bar. So they don't need to know anything else about me other than verifying my age. Other contexts, there's lots of other things. It might be if I'm making a large financial transaction, you want to know something about my history of transactions. You may not need to know my identity. We have in the financial world things like dark pools. There are lots of situations where there's a desire to trust that you are dealing with someone trustworthy, but there's actually valid reasons that have nothing to do with crime why the counterparty might not want to know, or the system only works if parties don't know who each other are. So the idea of decentralizing digital ID is there's not one database. It's not that there's a government entity or one entity or a private entity like a Facebook that has a list of all the information they control. There's a platform for making these attestations and a set of standards around them that can do it in a secure way. A whole bunch of different ways of doing this. There's some fascinating speculative work on what are called soul-bound tokens, which is using it with non-transferable digital asset tokens. But again, that's still at a fairly early stage. There's some pieces of this that are production-ready technology actually being implemented by some government agencies in some parts of the world. But we're not at a point where you can say, here's the one solution.
To me, I think, so long as you're not tokenizing it and trying to get investors to buy and sell it and promising them returns on it, and that it's got pure utility, again, have at it, do whatever you like. I do worry about the digital ID stuff. I think everyone should. Suppose you get pulled over, right? And the police officer says, give me your driver's license. And you decide, okay, the laws in jurisdiction allow him or her to do that to me. Then you step out and you say, okay, give me your phone. And you say, I don't want to give you my phone. But then you end up giving them their phone. They say, give me your code. Do you have to give them your code? Do you have to give them your finger? They might be able to use your finger under some case law to open up your phone or use your eyes. The answer is no. They need a search warrant in order to get your code. And even then, isn't that a Fifth Amendment violation? Aren't you supposed to not have to incriminate yourself? They're going into your mind and getting information from you. So I get nervous with the government knowing too much about me. I've already said that I have libertarian leanings, and I think that's the irony about all the crypto, because you talk about a CBDC, a central bank digital currency, and most pure crypto people will say it's a terrible idea because they thought of crypto because they don't want the government knowing what they're doing. So this is a real conflict.
Well, and there will have to always be a source of truth, right? That's the part that I try to wrap my head around. You're validating, you're authenticating with a database with information somewhere. And the question is, who's controlling and holds that information?
Right. I used to teach at the FBI Academy. Oh, go ahead.
No, I was going to say, I mean, yes, there in digital ID, we're concerned about the government having all of the information, but how our systems work today is everybody has all of the information. The government has it, and every single tech company has all of it. And every time I want to identify myself, I have to share all of my information with everyone. And so not only am I worried about the government, I'm worried about Clear and Google and, you know, everyone beyond that. And so I think the question for me with digital ID is how do we have the appropriate public-private consortium of, you know, that system that we all agree on that says, okay, maybe there is still the government entity providing the credential, the base credential, but then that's limited maybe in how they can use it. There's protections around that for the consumer, and that we don't have to keep sharing it over and over again, all those details, like Kevin said.
It gets tricky, and with the cybersecurity of it all, it gets really tricky. You know, I used to teach at the FBI Academy in Quantico, and the idea of a social security number being stolen, that's a big deal and an area for damages, and the papers will make a huge deal, or the internet will make a huge deal if some company loses your social security number. Well, guess what? Your social security numbers have all already been stolen. They're all already available at any time. So the idea that they somehow got released or exfiltrated because of some sort of intrusion is not going to make any difference to you because your number could already be out there.
No, I was just going to add, it's not necessarily the case that it only has to be the government. If the question is, am I an accredited investor? That doesn't involve any government agency. That if there is a way to provably identify my net worth, or even attributes of my level of expertise, which you can do that without the government being involved at all. So it's that disaggregation potential.
Well, those are the attributes of my identity, right? Like I am who I say I am, and I have a birth certificate and where I was born might need government, but where I got my degree, right? That could be an attestation from a university or from a trade school, and that, you know, I have a professional certification. That's another attribute of my overall identity. So I think all of these component pieces need to be added in and attested to, and that can create the holistic identity, but that requires all these moving pieces. So I think back to the kind of like futurist Web3 concept is just how do we create that system, and we're all agreeing. Again, I think back to, you know, maybe Director Chopra's earlier point, we need to all agree on the system. Even if it's not centralized anymore, we have to kind of come together on that.
Well, I'd like to pile on to say I think that's just about the best argument we have for needing regulation in this space right now so that we can coordinate that. This really is a coordination problem. And the problem is, and, you know, by the way, not financial advice, what I'm about to say, but if people don't find a way to do that in regulated fashion, it's going to be done anyways, and you are not going to like what it is being used for, right? Like I have the privilege of working pretty closely with some of the blockchain intelligence companies. Never, ever, ever use a blockchain to commit crime, right? Like it will be a matter of time until you eventually get found. I agree with John that we can't always interdict it yet, but we'll get there. It's public. They know everything. And once you start correlating that with all the other data we have, banking records, SARS reports, social media metadata, and putting those things together, you're going to be shocked at how much information leaks out of a public blockchain and reveals things. So privacy is about to get a heck of a lot worse, not better, if we don't solve this problem.
Yeah, 100%, Austin. And I mean, wait, is my thing on? No. Okay. Yeah, 100%. And I mean, this is a huge problem. I mean, we're talking about like, anonymous access to the financial system. And I'm like, that's where I'm like actually not seeing, because our clients have wallets that are attributed within a couple of days, within 3 days to us, right? Like, so, you know, I welcome you to go out and kind of talk about wallet attribution and what that looks like and how quickly that happens. But keeping, you know, the identity and the trade strategies of our clients private is a service, right? And so
can blockchains be consistent with the levels of privacy the public would require? And I've always wondered this as well. You know, you look at Bitcoin, and it, in many ways, is one of the most transparent forms of payment. As you say, it's a pretty dumb thing for criminals to use because it is very...
But it's so successfully used then. The government's not catching people, not in ransomware, not in terrorism, not in sanctions evasion. Every single crime, drug trafficking, human sex trafficking. And when you say the same could be done on fiat, I have to respectfully disagree. Because that kind of whataboutism, it's really not, I don't think it's an appropriate pivot. I think it's misguided because in orders of magnitude, if you look at what crypto has done in various criminal crime waves, and again, this is not anecdotal. I'm just speaking from the GAO report, the DOJ report, the Treasury report, the FinCEN report. You can look all of them up. You can, again, I've written a dozen articles on this subject, citing them all. So I I don't accept that. I mean, I respectfully disagree because I think you're right. Maybe something will change and we'll be able to find out who these people are, and it'll become a matter of international interdiction, which is impossible. You know, occasionally you can bring someone to justice in another country, but believe me, I worked so many investigations that involved other countries, and it was freeze the money that's here, put the border watch on, and that's the best you can do.
Yeah, I'll go the other way on that, though, and say I think it's a not yet, right? Which is to say right now, part of the problem is, one, as a general statement about all of these markets, crime always leads interdiction, right? Like people start doing fraud, the investigators get better, they start interdicting things. Two, I think it goes back to my earlier point about having underspecified some of these things, right? So like, again, I helped build PYUSD. There is a reason that has freeze capability, seize capability, account wiping capability. Now, if somebody hacks somebody in Russia and instead of Bitcoin being the thing that people prefer because people have disavowed it or it goes away, it's a dollar stablecoin, I can seize that right back out of your account while I'm sitting in New York at my desk and I don't need your private key. Yeah, exactly. And so, well, fiat-backed, well-designed stablecoins, because the world of things we call stablecoins and what are actually stablecoins do very different problems. So don't take that as generic about all stablecoins. But I'm saying part of why we have this need for coordination and thoughtful regulation, like from the NYDFS, because I know these are in your standards about digital currency, is we need to get to a world where we can optimize for some of the best components of this. And I think John is correct. If we can't get to a world where you interdict crime more effectively with blockchains compared to current with things like ransomware, you do have a problem. I'm just very optimistic on that solution.
So let me come back to Kaitlin on open systems. And we've touched on obviously digital ID and data, and there's this privacy conversation. But let's go broader with data. I mean, the ability of individuals to be able to control, their own data and kind of port where that data goes gets us into this open banking conversation. And I think it's an important one when we talk about Web3. So you've got, I guess we have 4 minutes left, Jalapa, but let's dig into open banking.
I'll try to cover it quickly. I didn't pay Daniel to let me talk about my favorite subject. I promise. But I think going back to digital identity, I think it's a particularly important use case when we think about data rights and we think about the ability for individuals to have access and transparency. Again, back to kind of the libertarian case even, like who do I know has information about me, right? And what ability do I have to go and say, that's not appropriate, you can't use it for these cases. So I think, from my perspective and a lot of the research I've done just says we need to have a base set of rights that kind of underpin technology and all these concepts of Web3 that say I as an individual have a right to access, to understand, to have transparency about the data that relates to me, identity or otherwise. And then at different cases, right, control that. In open banking, it might be to port it, to send it, or to share it in ways that ideally aren't just copy and paste, but maybe digging into systems that are a little bit more privacy protective. And then sometimes, right, another entity might also have some rights to that. And they've helped create that piece of data. They have a say in it too, and that's where we have to balance those things. So I think that's where, for me, privacy, security, open banking, this is all tying together.
Kevin?
Yeah, I was just there is a technical revolution coming in an area of cryptography known as zero-knowledge proofs, which doesn't have to be used on blockchains, used in a lot of these digital identity systems. A zero-knowledge proof is a cryptographic way that you can prove mathematically that something is true without knowing anything else about the one who's making the assertion. Well-established branch of cryptography, the problem has been these are so computationally intensive that they're not usable at scale. It's one reason that even though there are privacy coins out there, almost no one uses them, and the public blockchains you talked about leak so much information. Partly because of all the activity around crypto/Web3, there has been a huge upsurge in research in zero-knowledge proofs. And I was just talking yesterday, we hired someone at Penn named Pratyush Mishra in computer science. He's one of the leading researchers in this area. And I said to him, how far away are we in terms of the academic research to get to the point where these zero-knowledge proofs are sufficiently computationally efficient that they could be used universally on something like these large public blockchains? And he said 2 to 3 years. So come back.
I mean, can you give an example of zero-knowledge proofs? I know this gets thrown around a lot. Like, explain what we're talking about here.
Well, so I mean, it's something like that digital identity example I gave you. I can, I want to go to the bar. And so I want the hospital or whoever has my birth certificate or the DMV to be able to provide something that I can give to the bar that says this person is over 21 years old. The bar doesn't need to know anything else other than there is some person there who it knows it is the person who has the right through a digital signature to possess it. So it's something that very widely can be used to make various kinds of assertions without requiring that centralized database of the identity.
Yeah, real quick. Companies who are doing it, we were just at a conference last week, and there's a company, for an example, like Freeform, right? And they're doing a tokenized ability to pay, right? Where, because historically, right, like you go into a bank, there's a huge, issue with unconscious bias in lending decisions, et cetera. And so their whole thing is zero knowledge proofs using tokenized ability to pay, right? And working with the mortgage industry on that.
John's so uncomfortable right now. Go ahead, John, please.
I listened to, I read the Concerned Doc Tech letter. I appreciate it. Blockchain's been around for over 15 years now, even longer. And Molly White, who's a terrific technologist and software engineer, she wrote an article called It's Still Not the Early Days. And you look at blockchain, I listen to every single earnings call, Amazon, Google, Oracle, Microsoft, every single technology call. This is part of what I do anyway. So where were they talking about blockchain? Nowhere. Okay, there's plenty of marketing theater about Web3 or about, you might find a flashy web page. But ask anybody who works at those companies, what are you doing with this marvelous new, limited writer, append-only spreadsheet? And they're going to say, not much. And so I appreciate the aspirations of technology. And some people will say, my friend Anthony Scaramucci, we've been friends for 50 years. He's one of the closest friends I'll ever have in my life. We're on different sides of the coin with respect to Bitcoin, literally. And I know his heart's in the right place, just like a lot of people in this room or on this panel are. But it's all aspirational. Tell me something. If it was all gone tomorrow, would any of your lives change at all? If the cloud was gone, it certainly would. If iPhones were gone, it certainly would. If internet was gone, it certainly would. If blockchain was gone, everything would be the same for every single person in this room.
Yeah, I'll end by saying the problem is in this room, though, right? Like when I was at Paxos, 95% of the holders of BUSD, non-US persons, the majority of them in countries with major inflation because it was a way to get out of their local currency into dollars, right? A lot of people in Argentina would be very disappointed.
About in El Salvador, my friend Ben McKenzie and Jacob Silverman went down there.
Bitcoin's going to zero, man.
Let me ask one final question of all of you. In terms of advice, whether it's for innovators, for policymakers, for regulators, what's one thing that people can be doing to hopefully get to definition number 2, Kevin, of Web3? What are we missing? What can be done better?
So I'll say one thing is zoom out from the US and understand this is a global contest. Like one of my big worries is I would love for all of these things to come to the US in a well-designed regulatory framework so that if it's good and it works and it creates value, great, it's here. And if not, fine, we strangle it because the rules are correct and either you're going to do something proper with it or not. If you don't, these will continue to grow in places that are not so good. And in that context, we could have some real problems. Because here's a thought experiment I was presented with. I'm going to start with the parts that will sound maybe good to some of the people in this room. US dollar stablecoin, all right, backed only with T-bills, 90-day maturity or less. Okay, so this looks like a government money market fund with reserves, attestation, all the stuff you would like, except it's custodied at the banking system of a country that doesn't like us at all, yet we trade with a huge amount and isn't going to obey any of the sanctions regimes. Right, these things are being built right now. The thing I just described actually exists in the world. You can figure out which project it is. So I think we need to bring things here for the safety, security, and soundness of the system, and they'll die if they're not useful, and they can grow if we have good rules and they're useful.
Great. Rachel?
Yeah, I think that I would say that we need to understand what our role is individually, right? So we have, I'm kind of looking out at this audience and I see one protocol founder. And so I see a lot of regulators and other kinds of people on the outside of the space talking about use cases, right? I am not being here to ask to define what the use cases are. That is just not what my role is. My role here is to build infrastructure. Your role here, if you're a regulator, is to give requirements around how to meet regulatory mandates. And I think that if we all kind of understand what our role is here, and engage with each other across the space as to what are the use cases, what are the missing pieces of critical infrastructure, how do we together meet regulatory mandates, how do we solve for some of the things that you're talking about, John. I think that we'll be able to foster a lot more innovation than we otherwise would.
I know we have less than a minute, so yes, please.
There's only one thing that needs to change in order to foster the innovation that everyone wants, and DOJ has to put more people in jail. When the Winklevoss twins, one of them said the SEC violation that he gets charged with is just a parking ticket. He was really kind of understating it. I mean, you had a panelist from Coinbase just earlier, and I don't think an SEC, and Coinbase has been sued by the SEC, and I don't think it's a parking ticket in their view, it's a badge of honor. So until DOJ does something, none of the good things that all these people want are going to happen until people are put in jail.
Well, no, I'm an optimist about this, but I would say that there are some serious unregulated offshore actors. FTX was one of them, and they're not around anymore as such. But platforms like Tether and Tron and Binance, who are very large players in the system, who are pretty much outside the regulatory perimeter, although they often claim to be inside of it. That needs to change. And even whether they are in the U.S. technically or not, they're such a part of the digital asset system that does need to change in order to move forward. And then beyond that, it's just more of these conversations among regulators, policymakers, and people in the industry, especially getting technical conversations going on about, all right, what exactly are the problems and how can they be mitigated in a practical way?
Kaitlin.
Say, more breaking down into component parts, because I enjoy that.
All right. Well, I think we were both spicy and ambitious. So please join me in thanking our panelists. Excellent.